Welcome to Cost and Management Accounting. It is highly likely that this will be your first encounter with management accounting and finance. So I'm sure you await your commencement of this module with more than a little degree of trepidation. There is nothing to fear. Management accounting and finance is an exciting and ever-growing part of the broader accounting field. Just to introduce what we want to talk about, I'll begin by giving a definition of accounting, with that understanding that some of you might not have the background that is necessary for accounting. Accounting is quite a wider term and includes recording, classifying, and summarizing of business transactions in terms of money, preparation of financial reports and analysis, and interpretation of these reports for the information and guidance of management. So the central key here is we want to give guidance to management. And we have got accounting systems that we have, and basically there are three of them, namely financial accounting. That's the first system that we have. Secondly, we have cost accounting. Thirdly, we have management accounting. But for the purpose of this study, we are going to focus on the last two. That is cost accounting and management accounting. And broadly, we are just going to refer to both of them as management accounting. Let me focus on financial accounting, because here we're talking about these two that we want to zero in on. So I want to talk about financial accounting. Let's define it. Financial accounting may be defined as the science and art of systematically recording. That's the first aspect. Systematically recording, classifying, and summarizing business transactions of financial character. And then finally, interpreting the results for determining the financial profit or loss at the end of an accounting year. So you'd see that financial accounting is mainly concerned with the determination of financial profit or loss at the end of any given accounting year. That's the ultimate objective. It also shows the financial position of the firm, and thus it records and reports financial statements. You notice that financial statements we are talking about basically the assets of the entity, the equity, and the liabilities of an entity. All this information is contained in the balance sheet. And also, we also have the income statement and statement of cash flows, which are also mainly used by external users. We can also look at the other side of the story, where we are now focusing on management accounting. Later on, I'm going to show you the differences that exist, just a summary of the differences between these two pillars of accounting. Management accounting, here we're looking at the collection and provision of information to assist in decision-making, planning, control, and performance evaluation. One very important point to note about management accounting is that it assists or enhances the decision-making process. So it aims to provide information to management level employees of any given entity so that they can make better decisions. So we are concentrating on management level in an organization, which is the upper part of the organization. And what are the functions of management accounting? The first function, if I may just summarize the functions of management accounting, the first function concerns decision making. This is a very vital part in management accounting because every day managers are making decisions which are very critical for the organization. So management accounting, the first function is to assist in decision making, where managers make selections between different options which can be there. Like one decision that I can just think of, maybe should we close this department? Maybe an organization having several departments, and then a decision has to be made on whether to close a certain department or to leave it running. So between those two options, management must make a decision. And that's where management accounting comes in. It will assist in decision-making. The second function is on planning decisions. Planning decisions here, when we talk about planning, we're talking about the process of coming up with goals. We set up goals that must be achieved. So management accounting helps in planning decisions. Normally, it is said if you fail to plan, then everything else about that organization will just crumble. So management accounting helps in planning decisions and also controlling, that is addressing deficiencies in performance. When goals have been set, there's no guarantee that they're going to be achieved. Sometimes there may be deviations, some or variations from the set objectives due to a number of reasons or to a number of constraints. So management accounting will also assist in controlling those deficiencies so that the organization is brought back on track so that the perceived goals are achieved. Then finally, it also helps us in organizing. Organizing, we're talking about ensuring that all resources are adequate in the various functions within the organization. Organizing, we're looking at resource allocation, the allocation of resources, which are normally very scarce in any given situation. Resources are never sufficient. So management accounting will help us in ensuring that resources are adequately allocated across the organization. So I'm going to look at the differences that are there between financial accounting and management accounting. As you can see, the first difference that I want to talk about is about who uses what, the users of these two pillars of accounting. When you look at financial accounting, you will notice that it is mainly used by external stakeholders. Here we're talking about shareholders and creditors. They are outsiders as far as the organization is concerned. On the other hand, management accounting is mainly used by internal users, or it's mainly for internal use that is within the organization. And in that regard, we are talking about executives, managers. That's where management accounting is very useful. Another point concerns purpose. The purpose of financial accounting tends to be more general. It is general because we're looking at preparation and presentation of financial statements. The ones that we're talking about, financial statements, we're talking about income statements, balance sheets, statements of cash flow. So it is more general as compared to management accounting, where management accounting, its purpose is specific. There are specific reports that management may require, which must be prepared periodically. So that's one very important difference there. Another difference concerns timeliness. Financial accounting is historically based. Its information is mainly history. What are we saying here? Transactions, first of all, happen. Having happened, then we are now looking in retrospective. What have we, how was our performance? It's now historically based. We're looking back. Yet, on the other hand, when you look at management accounting, it encompasses the past, the present, and the future. All aspects, they are dealt with under management accounting. We're looking at the past, the results of the organization in the past, and what is the current position of the organization, and what is the future. It means we are also focusing into the future. Another difference, again, is on restrictions. As far as financial accounting is concerned, it is more regulated than management accounting because it must adhere to international financial reporting standards. It must be standardized. And also it must be done in accordance with local tax laws. It cannot just be done haphazardly. It must be within the prescribed international financial reporting standards, or IFRS. While on the other hand, management accounting, there are no external restrictions. You'd notice that firms can have different ways of presenting their management accounting. They will vary from one organization to another, depending with the purpose that must be achieved by that particular organization. Let's look at type of information. Financial data, as far as financial accounting is concerned. The type of information that is presented in financial accounting tends to be financial in nature. They are figures in nature. And then, on the other hand, we've got management accounting, where the type of information is economic, physical, and financial. It encompasses all the pillars. That is financial, physical data as well. Economic data is also inscribed within management accounting. It is more broader as compared to financial accounting. Let's look at the nature of information. The nature of information under financial accounting tends to be factual. That is, it is characterized by accuracy and objectivity. It must be reliable. The figures must be reliable. The figures must be accurate, and they must be objective, not subjective. They must be accurate. While on the other hand, management accounting, it has got facts and estimates, which are intended to influence future value. There are projections that are mainly found under management accounting. For example, we can make some budget estimates, maybe the cost that would have incurred in our products. They can be based on budgeted information, which may not be the correct information that would have transpired. So management accounting is mainly based on estimates. whereas financial accounting is based on factual information. Let's look at the scope. Financial accounting looks at the entire organization. The information is aggregated for the entire organization, for the whole organization, while management accounting, the information tends to be specific to particular departments. That is, we're looking at the products and the processes involved in each specific department. We may look, for example, maybe is the painting department. Maybe we're looking at an automotive engineering company, where maybe we just zero in on the painting department. How are the cost behaviors in that particular department? How is the performance in that particular department? That kind of thing. Whereas financial accounting looks at the entire organization and all the departments, the entire organization, how is it performed in a given period? Then frequency of reporting. Financial accounting emphasizes on annual reports. It's normally done at the end of a given annual period or financial year. What was the performance? Thus, the frequency of reporting, normally at the end of a given year. Whereas management accounting, the reporting frequency is continuous. It can be weekly, it can be daily, so the reports will be at short intervals and continuous throughout the year. Now, we want to look at cost accounting as another branch of accounting information system. Cost accounting is that branch of the accounting information system now, which is concerned with recording, measuring, and also preparation of reports about cost. The main concern of cost accounting is cost. You know, it's an aspect that normally a number of entities ignore. How much cost have we incurred before we can talk about the pricing, before we can talk about selling our products or selling our services or selling our goods? We need to identify the cost. So cost accounting is about recording and measuring, and then we report information about cost. So it is a process of compiling and aggregating the cost of producing certain products or the cost of providing certain services or undertaking certain activities. Right. The primary purpose now of cost accounting is cost ascertainment. We want to ascertain the costs that are involved in whatever activities that we are undertaking, and its use in decision-making and performance evaluation. Decision-making sometimes, or to a great extent, they depend on the cost that an entity would have incurred. If you cannot really identify the cost involved in an activity, it is difficult to make a decision whether to continue maybe sometimes or to abort whatever project you intend to undertake. You have to count up the cost. So that's why cost accounting is of paramount importance in as far as decision-making and performance evaluation. How have we fared? How is this department fared? How is this branch fared? All that information can be revealed through a cost accounting system. Cost accounting, on the other hand, is also used by both financial and management accountants. It is of very paramount importance to both the financial and management accountants. Right. Let's also try to break down the meaning of cost accounting. You will notice that cost accounting is concerned with recording. That's a very important point. Classifying an appropriate allocation of expenditure. Because once expenditure has been recorded, it must be classified. We classify it, and then we allocate it appropriately. Why? For the determination of the cost of products or services. And this is going to help us in controlling and guiding information to management for decision making. When we're talking about cost, we're talking about the price paid for something. You may have a question on what is cost, but cost, we're talking about the price that we pay for something. And then when you say cost ascertainment, we are talking about the computation or derivation of actual costs that we've incurred in a process or in a procedure that must be undertaken in the production or provision of goods and services. Then cost estimation. Cost estimation is a process of predetermining cost of goods and services. We are trying to have a forecast of our cost. How much cost do we think we are going to incur? Normally, when we've been in business for some time, it's easy to project, to have a projection of the cost that we think we may incur in a given period. Then I'll just summarize the cost accounting system or process from what I've been talking about in the previous slides. Just to sum it up, you realize that the first process is to determine your cost. Let's determine the cost. If we determine the cost, here on the cost, it could be the cost perhaps of the material that is involved. Maybe in the production of a certain type of a product, what material is needed? How much material is needed? How much labor is needed? How much overheads do we think we are going to incur in the production of a product? After cost determination, then we go to cost record keeping. There must be a record, an accounting of the cost. After that, then we analyze. We're talking about cost analysis. We analyze the cost, the trends in the cost, the patterns in the cost, and the figures. We are now looking at the sensitivity analysis. That's another aspect that's involved in cost analysis. Then we look at cost management and control. We are now trying to manage our costs. We're now trying to control our costs so that they don't balloon, so that we don't overspend, so that we are within the confines of the expected objectives of the organization. Then finally, we have reporting. We are now giving a report of the cost. That's cost reporting. The Chartered Institute of Management Accounting, it is an institute for management accountants, normally known by the acronym CIMA. It has got a well-established and publicized code of conduct, which guides its registered members. So you notice that management accounting, there is an institute that governs the operation of all management accountants. So they must subscribe to that. There must be registered members in order for them to be recognized as management accountants. So CIMA has a well-established code of conduct, which must be adhered to by all registered members. And here are some of the codes of conduct which management accountants are expected to abide by. Integrity, that's the first one. Integrity is very critical in as far as management accounting is concerned. Integrity, we're talking about honesty and straightforwardness in all dealings. Without honesty, it will be difficult for management to have confidence in management accountants, because they must be people of high integrity. honesty, and as far as their dealings with stakeholders are concerned. Objectivity, that's another code of conduct. There must be objective and not be biased in their dealings, in their operation. So objectivity prevents bias and conflict of interest from clouding their professional judgment. Objectivity is very critical. Their views, their dealings must not be biased. Once they are biased, then the whole purpose of accounting and reporting would have been defeated. Professional competence is another very critical area that is expected of management accountants. They must be competent to deliver the expected knowledge or the expected roles or tasks that must be performed. So for that to be achieved, there is need for them to be constantly improving on their knowledge and skill in accordance to developments in the field and legislation and accounting techniques, because accounting is a very dynamic area. Standards, they are continuously changing. Ways of reporting are consistently, they are continuously changing. Legislation will be changing. Accounting techniques will be constantly changing. So a management accountant must be abreast of all those changes that are happening within the profession. Confidentiality, that's very critical. You can imagine, because you've been invested with all the authority and the trust to know information which may be very sensitive. So management accountants must be people of high confidentiality. They must be able to avoid the disclosure of confidential information without permission from the entities that are involved. The other point is on professional behavior. All relevant laws and regulations are to be complied with, and the member should refrain from engaging in any activity that may bring the institution into disrepute. It is quite interesting that sometimes even your social behavior, your social misbehavior can also affect your professionalism. So you realize that management accounting, they're expected to adhere by these high standards of conduct in order for them to be recognized in that capacity. Just to sum up what we've been talking about, just to go through the cycle of management accounting. We are talking about the first point being recording of cost data. Data must be recorded. All the cost data, all the cost elements must be taken down. There must be an accounting, a record keeping of all the cost data involved. Then we go to classification of cost. Cost must be classified according to the different categories that we have. Okay, there are different ways of classifying. Of course, we can classify maybe according to behavior, whether these are fixed or these are variable, or there are different ways of categorizing our costs. Then we determine the total cost now. We are now aggregating all the costs to come up with total cost. Having determined the total cost, then we come now to unit cost. Because without the unit cost, it's very difficult to ascertain the selling price. If we determine the unit cost, then we can be in a position to determine the selling price. Once the selling price has been recognized, then what do we do now next? We control our cost. And then decisions must be made depending with the performance that would have been achieved. There can be decisions sometimes maybe to change the price. Maybe the selling price is too exorbitant or anything of that sort. So there is need now to control the cost and to make decisions that are necessary in line with the performance that would have been achieved in that particular period. That brings us to the end of our lecture. Thank you very much for your time and for taking part in this lecture. Good day.